I'm Stan Barnes, and I'm here with Eddie Hatch, and we're Barnes Capital Group. Welcome to this 8th edition of Barnes Quarterly. We find ourselves in the fourth quarter of 2020, and it's been an eventful year for sure. One of the biggest events, at least for us here at Barnes Capital Group, is Eddie Hatch and Taylor Hatch have got a new addition to their family. Eddie, why don't you tell us about that?
Yeah, so my wife and I, we had a new baby on September 27th. His name is Waylon Nix Hatch, and he is already running the household along with our 4-year-old. They've kept us busy, either chasing kids or changing diapers. So lots of changes for us.
Speaking of which, you're in a new home.
That's right. We also moved into a new home about a month before that. So
rather than spacing that stuff out, you just wanted to do it all at one time.
That's right. Cram it all in and get it out of the way. And we're finally starting to get settled down a little bit.
Well, we're going to spend the majority of our time today speaking with our Chief Investment Officer up in North Carolina, Chris Zaccarelli. Given the upcoming events here in the next couple of weeks with the presidential election, the national elections, and local elections, I don't think Chris is going to comment on that. But so we really wanted to dedicate most of our time to that. We typically, this time of the year, find ourselves with our clients with a lot of meetings going on, maybe enrollment meetings for group benefits or financial planning meetings with individual clients, fiduciary meetings with 401k clients. So it is typically a busy time, and also we try and get people thinking about maybe doing some tax planning going into the new year. We've also got some news about a new website which should be coming out shortly, hopefully by the time you receive this podcast. For that, I'm going to turn it over to Eddie.
Yeah, so one of the things that we've been working on lately is a new website. We hope to have that rolling out here very soon. We've been working on it for quite some time, but we just felt like we were ready to make some changes. The way the website had the look and feel it had for our participants and clients. We also started using some new tools and technology that we thought would be good to help incorporate into that system. I'm here with Austin, who works at Compass Marketing. They've been helping us with that project, and we're just going to turn it over to him and let him tell you a little bit about that website and what it's going to look like moving forward.
Well, when we first approached the website, we decided we wanted to really emphasize clarity and accessibility, as well as increase the overall approachability of the website. So you'll find that the new site is not only more modern, but more easy to use overall. And one thing that we've always liked about working with Barnes is their dedication to improving and innovation, so that they're always kind of top of market for their clients. And so we've created some new interfaces that integrate with some of these new tools that Eddie has mentioned, Riskalyze and eMoney. So hopefully you'll have a pretty awesome experience using these tools moving forward, and you'll find value.
Yeah, thanks, Austin. Those tools you mentioned, Riskalyze, eMoney, those are going to be great pieces of technology that we're going to utilize moving forward to help improve and increase the client experience. It gives them the capability to be more involved in their own financial planning as opposed to us doing everything on the back end. It's something that we can still do if they want us to, but if they want to be a part of it, they have the access and ability to do that themselves also.
Also, in an effort to kind of respond to recent requirements, due to current circumstances, we've introduced some tools that allow our clients to schedule virtual appointments with us, as well as attend virtual appointments with us. We think that'll be very beneficial moving forward as we all kind of weather this storm.
So thanks, guys. Appreciate you sort of giving us an overview of the new site. We're very excited to roll that out. We're obviously in a world that's dealing with new ground rules with how we interact with clients. There's absolutely no substitute for meeting personally and directly with you all, and that's our preference, but understand that we need to be able to accommodate whatever our clients are comfortable doing, and these virtual capabilities, I think, will really be helpful going forward until things do settle down in the world. And with that, let's turn over to Chris Zaccarelli. It's interesting that we happen to be having this call on this particular day, Chris.
It's a nice drop in the market. It's very exciting.
So it's October the 26th. We're in the home stretch of the year, fourth quarter. Today, the markets are trading off pretty significantly, with the Dow down, at least last time I looked, about 750 points. And the markets seem to be keying off the stalls and the stimulus talks in Washington, as well as somewhat of a spike in the COVID cases out there across the country. We obviously, all the buzz right now primarily is on the upcoming presidential election. Well, really all the elections across the country, and sort of what we're going to end up with whenever all the votes do get counted. I mean, obviously there are a lot of moving parts right now here in the fourth quarter, and we'd like for you, maybe if you could, just sort of frame that up for us.
Sure. Well, looking to the fourth quarter, as you mentioned, this is an election year. We've got a presidential election on November 3rd. There's the Senate is up for grabs as well, and the House, as it is every 2 years, is also up for re-election. Most people are forecasting the House will stay Democrat. So really the two elections of consequence are going to be the President of the United States, and then whether or not the Senate, which is currently 3 seats in Republicans' hands, will swing back to Democratic control. And so markets are both looking at what's going to happen with the elections, both the presidency as well as who's going to be in control of the Senate in a week or two. And they're also taking a look at stimulus, which is something that people were hoping would happen before the election. Although, frankly, I really didn't think there was much chance, given kind of the political divide that we have in Washington, of passing anything prior to November. So it's not as much a surprise to me, but I do see the markets taking it pretty badly today.
Well, obviously, I know it would be tough, and don't want to put you in the position of handicapping who's going to win. But each camp has sort of got their own opinions on that in terms of what the momentum that's growing. And I guess if you follow the mainstream media, sort of the message that's being sent is that the economy is really struggling and so forth. But I think, at least as we're getting numbers in from last quarter, they seem to be a little contradictory to that position. And we've got GDP coming out, that's gross domestic product, this Thursday. What are your thoughts about that?
Well, I think you're right. I mean, if you look at what the media is portraying, it definitely shows the economy is pretty weak. And to be fair, clearly it's been knocked down because of the COVID lockdowns and a lot of the basically decisions by the general public to stay away from airlines and cruise lines and a lot of typical travel and leisure type of companies. And so there is some weakness there. But to your point, the GDP number for Q3 should be out in a couple of days. It'll be out on Thursday. And I believe we're going to see a really historic number to the positive side. So the good news to everything that happened in the second quarter, which was an historic drop in gross domestic product, we should see a really nice bounce back this week. Now, whether or not that bounce back leads to more confidence when people go to the polls remains to be seen. And to your earlier point about who's going to win the election, I think if anything, we all learned a lesson in 2016 that just listening to the polls and to the political experts, they don't always know what's going to happen either. Myself, I've never considered myself a political expert, but I do try to follow the experts closely, and I try to make sure that whatever we're doing within our portfolios makes sense in the context of what's likely to happen. And so I think, there's a lot of uncertainty heading into this election. Whether or not President Trump is able to get reelected remains to be seen. It does look like the odds are stacked against him, but he was facing similar odds back in 2016. And also, the Senate is very much up for grabs, with a lot more Republicans having to defend their seats than Democrats, which is the opposite of what we saw 2 years ago. So there's a lot in flux. From a portfolio point of view, we try to make a lot of our decisions, based on, regardless of who wins, what's most likely to benefit. Or conversely, if we have a lot of uncertainty as we face now, sometimes it makes sense to take a little bit less risk. So you lock in a little bit of your gains for the year. You try to reduce a little bit of the risk in the portfolio. No one can time things perfectly, so it's important to stay fully invested. But it does make sense to take a little bit less risk in the portfolio or a little bit more risk, depending on where valuations are and where you've got certainty. And right now, valuations were pretty high coming into today, and the uncertainty factor is very high as well, which is augured for a little bit more defense than offense at this point.
So by the time that listeners receive this podcast, the elections may have already taken place. Who knows whether all the votes will have been counted. Obviously, there's been quite a bit of discussion on that. But handicap, if you will, I mean, I know that there are sort of different schools of thought out there, whether it's better for markets if the Democrat gets elected or a Republican gets elected. Do you have any thoughts on that?
I do, and I think it's going to be interesting because regardless of what happens, there's going to be some positive for markets and some negatives. So let's take a look at the prevailing consensus, at least by what the prognosticators are saying, which is that the Democrats will take control of the White House, and there's a good possibility that they take control of the Senate as well. That's the so-called blue wave, where Democrats will control both the House, the Senate, or both the House and the Senate, in addition to the White House. Under that scenario, the Democrats have said they plan on raising corporate taxes. They'll likely raise taxes on individuals, and all things being equal, higher taxes are worse for the stock market and potentially could slow the economy down. On the other hand, Democrats have also indicated a willingness to spend quite a bit in terms of fiscal stimulus. So a lot of the discussions that have happened over the last month or two has really been about Democrats trying to put together a very large package, $2 trillion or higher, whereas some of the Senate Republicans have been urging a little bit more fiscal constraint. And I say a little bit more because when you're trying to argue about $1 trillion or $2 trillion, it doesn't sound to me like either party is being especially fiscally responsible. However, we are in the middle of a crisis, and it does make sense to provide some type of stimulus to the economy. And as usual, the devil's in the details, and that's really what's going to matter both to the stock market as well as to the economy as a whole, exactly where money is put into the economy and how efficient it is in getting there. So, but the general consensus is that if you do have this blue wave, despite the fact that taxes are likely to go higher in 2021, just because there's going to be so much extra fiscal stimulus, that could actually be good for the stock market in terms of moving the market higher. Now, the deficit spending, the federal debt exploding, there's a lot of negatives down the line. Someone is going to have to pay for this either literally or figuratively. But in the short run, people believe that the stimulus package, if it's large, will actually be a bigger positive for the market than necessarily higher taxes will be negative. And so that's the consensus that's in the markets right now. It remains to be seen whether or not that's true, but it all comes down to what market participants focus more on. Do they focus more on the extra stimulus dollars hitting the economy, or do they focus on the fact that higher taxes, all things being equal, lead to lower corporate earnings?
So that's if the blue wave occurs. What about the flip side of that?
So the other two scenarios that are most likely, you either have a President Trump victory, a re-election, and the Republicans hold the Senate. And if that's true, I think you'll see more of what you've seen this year. Effectively, there will be no change in the White House, no change in the Senate, and as we discussed previously, there's likely to be no change in the House. And so under that scenario, you'd expect to see less stimulus than otherwise would be expected. You would expect that corporate tax rates would stay right where they are. And so really, I would think under that scenario, it's going to be the virus and the consumers' reaction to the path of the virus that will matter the most. So whether or not we get a vaccine, whether or not we have increasingly effective treatments. But ultimately, in order for the economy to get back to normal, you need consumer behavior to get back to normal as much as possible. So I think you'll see a little bit more status quo and will be less in the hands of the federal government in terms of fiscal stimulus and more in the hands of what happens with the virus. Interestingly, I think the most challenging scenario, and one that's not at all unlikely, is that President Trump wins re-election, but the Senate flips to the Democrats. Again, it's not the most likely scenario, but it's not a completely impossible scenario whatsoever. It's well within the realm of statistical error, at least as you look at the polls that seem to be favoring Biden and seem to be favoring Democrats. And so in that scenario where you've got a President Trump and you've got a united front in both the House and the Senate, you're likely to see a lot of gridlock. And ultimately that may be pretty challenging for markets. Now, whether or not President Trump decides to buck his own party and to sign into law some type of compromise, let's call it on infrastructure spending or other priorities that President Trump might have, That's something that I think could eventually happen. But given the political discord that we've seen, given the fact that it really seems that in addition to Democrats being opposed to Republicans in general, like they always have, they seem to be especially opposed to President Trump particularly. So if there is a President Trump and a Democratic Senate and a Democratic House, regardless of whether or not infrastructure spending eventually gets passed and President Trump signs it, I think we may see it. That may take a while. So I think really under those two other scenarios, you're gonna see the stock market really suffer in the short run, because it's going to be trying to figure out what's going to be the path of virus, what's going to be the path of the economy, and when and if stimulus will actually make its way back to the system. So I think those are the three scenarios that we're most likely dealing with as we look to the next few weeks, if not next few months.
Chris, I was just saying earlier, having a discussion that we've been having with a lot of clients, and you and I have discussed this previously, but the same question that we're getting from many of the clients, which are, with this election coming up and so much uncertainty with the coronavirus, should we sit on the sidelines until we get some more certainty?
Yeah, and that's a question that I've heard a lot from a lot of clients, and the problem with a straight answer on that is just no one knows. You don't know when the market's going to decide that there is certainty in the outcome. There's no way to know whether or not the market is going to take the results well or poorly. And so again, if you look back to 2016, the broad consensus was that President Trump was going to lose, which was wrong, and that if he did win, that the market was going to get crushed by 10-15%, which was exceptionally wrong. So the real hard part in trying to make investment decisions based on what the future outcome may be is, one, you don't know what the future brings, and you also don't know that even if you knew the outcome of the election, what would actually be the market reaction at that point in time. So for that reason, I really try to advise people. It doesn't make any sense to do market timing. You as an individual client especially should not be doing market timing, because that assumes that you know better than the other people who've been working in this market for 30, 40 years and do this day in, day out from a professional point of view. And frankly, I also feel a little bit humbled by what's happening in the markets. And despite the fact that I try to make the best decisions that I can on an ongoing basis, I'll be the first to admit that I don't know what the rest of the world's going to do and how they're going to do it. The best thing I can do is constantly focus on where are there good values, where's the best risk-reward trade-off. And despite the fact that the future is unknowable, you just try to put yourself in the best position for the best possible results. And really, that just comes back to time. The more time you can spend in the stock market, the less it matters knowing exactly which day will be the bottom, which day will be the top. You just let time do its thing. That's been the one free lunch in all of investing, is just having time in the market. So moving to the sidelines doesn't make sense if you're trying to capitalize on what may or may not happen in the future. However, if you need cash next year in 2021, or there's a potential for using money in the short run, absolutely you should have already pulled that money out of the stock market. But where it does not make sense to stay fully invested is if you actually have needs in the short run. But if you need money 3 years from now, 5 years from now, 10 years from now, to the best of your ability, it makes the most sense just to stay invested, because 3 years from now, 5 years from now, 10 years from now, the market's likely to be much higher regardless of what's happening. And you can look no further than what happened in the financial crisis in 2008. That was a much greater threat to financial markets, to financial stability, and to our way of life than anything that we've seen in this past year. And within 3 years, the market was back to flat. And within 6 to 10 years, you saw the market double and at one point really triple off the bottom. So if something like the financial crisis, which is a once in 100-year impact to the financial markets, can keep the market down, I find it a lot harder to believe that something like this, which in and of itself is unusual from a public health point of view, but clearly from a markets point of view has been a lot less damaging and for a lot shorter time. It's that much more difficult to move in and out of the market, not to mention the tax consequences of doing so. It almost always makes sense to stick with your plan, whatever that might be, according to yourself or to Stan, and that's really the best advice that clients could probably take.
So again, the listeners might be receiving this after the election, but just to highlight your earlier comments, if somebody is going to have some immediate needs for their retirement monies, say retirees or whatever, they probably need to keep some dry powder on the sidelines, or get some dry powder on the sidelines to cover their expenses in the coming 12 to 18 months. But for those that have really a longer investment time horizon of, year and a half, 3 years, 5 years, 10 years, it would be advisable most probably to stay the course and not try and time the market.
I think that's exactly right. Yeah, I completely agree with that. And again, it's just a matter of trying to stick with your plan, because although this election could have lots of twists and turns, it's what they call a known unknown. The entire market knows an election is coming on November 3rd, and there's plenty of people who are thinking about all different scenarios, whether or not the election is contested, whether or not the election takes a little bit longer than it normally does in order to be decided because of so many people doing absentee ballots and so many people voting early. But at the end of the day, this is just one more event that the market will see and then move past like it has all the others. And so for that reason, you really don't want to treat this election any differently than you've treated the last 30 to 50 years in terms of market moving events. In hindsight, they'll all be pretty small events, even though they don't feel that way as you go through them.
Well, listen, that's probably about all the time we've got, Chris, but we really appreciate you carving out some of your afternoon for us, as always. And we've got a lot of things on the calendar coming up, but besides the election, the holiday season, and so forth, which is probably going to be different for all of us. But at any rate, thanks very much, and obviously we'll be in close touch with you as we move into the ending of this year, 2020. And again, thanks for your time this afternoon.
Thank you again for giving me an opportunity to speak with you and your clients. I hope everyone stays well, and if we don't speak, I hope you have a happy and safe holiday season.
There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee the strategies promoted will be successful. All performance referencing is historical and no guarantee of future results. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.